I may not be the brightest light bulb in the fish tank, but at least I'm not a bear. And just as bewildered bears started to beat their chest and finally enter short, the bulls decided Friday isn't risk off anymore. No, no, no. Friday is dippity dip, rip your face off. And even though I prefer intact faces, the chips and dips rally continued. Not even a hot PCE could stop the train. So with good news, and bad news, good news, and the stock market in full Ponzi mode, how exactly do we profit? Well, the better question is, how do we not profit and then work backwards? So that's what we're going to do today. Work backwards. Let's roll the tape. This is the weekly heat map of the S&P 500 and a very bifurcated trade. A lot of green on this side of the heat map, a lot of red on this side of the heat map. We saw the big boys really get sold off this week. They did recover towards the end of the week, but net down in total. Apple, Google, Meta, Microsoft, semis, and even some of the other names outside of the technology space, Visa, MasterCard, Eli Lilly, right? They got sold. Tesla, Walmart, Costco, just the growth names in each sector really took it on the chin. But the rest of the market was actually really green. If we actually dive into the sector analysis, you have a look at XLC, XLK, XLY, and then energy. They were the only sectors down on the day. These three, XLC, XLK, XLY, right? So the technology sector, Nvidia, Apple, Microsoft, Google, Meta, and then Amazon and Tesla all underperformed the SPY. So rotation out of the Magnificent Seven, out of tech into the rest of the market. Now, we did see defensive sectors do the best, XLU, XLV, and I think that's because a lot of the political uncertainty we saw on Tuesday and Wednesday really took the market by surprise. And I think some of the bigger institutional funds just wanted to get a bit defensive leading up into this election. And that's why we saw utilities and healthcare up 1.48, 1.41%. We then saw XLB materials, commodity-driven sectors do pretty good, but not so much on energy. Energy tends to be very volatile. And then we had cyclical sectors also do really well. I mean, XLF, XLI, XLRE, XLP up 1.31%, 1.15, 0.45, and 0.51 respectively. The SPY returned 0.83%. So more sectors actually beat the SPY, but still returning negative. It goes to show the weight of the tech names in the sector and is not representative of what actually happened under the hood. We saw the IWM up 3.4%, very strong. The RSP as well up 0.8. Bonds flat on the week, which is kind of crazy because we got great economic data today. You think yields would spike in that instance. The opposite happened. Very weird trade that we saw here in bonds and yields. And then the S&P 500 down 0.83%, commodities down 1.26%, and then the Nasdaq 100, the worst performing sector, down 2.56% on the week. And it really was just a small cap driven rally in every factor. Value, core, and growth this week all outperformed, and then mid cap, value, core, and growth in that order. Large cap value was positive on the week, and then growth, momentum, and growth got absolutely hammered. Small caps were the big play, value, and then dividend and low volatility also positive on the week. So it really just was, these tech names, these mega cap names, these growth names that really got sold. And we definitely are starting to see a rotation. The rotation is alive and well this week. And I think we are going to get more of the same in the week ahead, especially when we look at the IWM. This looks very strong in contrast to the S&P 500. Clearly in a daily downtrend, that is the S&P 500. The IWM came down, but didn't continue like the S&P 500. And the large caps did. In fact, formed a bottom right here and actually has moved higher, extremely resilient. And price discovery at these upper levels simply opens up levels on the upper end at 244, new all-time highs. Now, the weekly chart of the IWM looks very constructive. This is a legitimate breakout. This right here is genuinely a breakout out of this correction zone we saw here. A little bit of a time price correction in the IWM after the big time price correction we saw right here. And I do think that we probably are going back to all-time highs in the IWM. There's no real analysis that I could do right here for you guys. That's a strong weekly candle, minimal upper wick, closing in the top third of the candle. Very strong. That's a green candle. For the week, the IWM is up 3.4%. Absolutely crazy. We're going back to all-time highs. You want to stay long. You should really already be in right here. I told everybody to buy. This was a great buying opportunity. This was a great buying opportunity. This is actually where I said everybody should get into small caps at the end of 2023. and look at where we are right now. If we actually take a measured move, up 38% since late 2023. Insane move here by the Russell 2000. Stay long, stay the course. I think we're going back to all-time highs. Looking at the S&P 500. Now, let's actually look at the weekly chart. So pretty ugly when you look at it. Down 0.83% for the week. However, still in a weekly uptrend. And to be honest, this sell-off looks very orderly in my opinion. We did see bulls come in here towards the end of Friday. Look at that upper wick. And what we really want to see on the daily chart is follow through in the bullish momentum on Friday. Retake the gamma flip. If bulls can do that, that opens up the 5750. However, if the bullish momentum stalls anywhere below the gamma flip, I think we're going to see something like that in the S&P 500 next week. A lot's going to be dependent on data as well. We get NFP as well as the FOMC. I don't think the FOMC is going to cause a lot of volatility. In fact, I think the Fed's probably going to come out a little bit more dovish with the data we've seen this week and in the last couple of weeks. They're going to still try and buy their time, keep their options open. I think the big thing that can cause volatility is the NFP. The one thing that's holding this entire market together is the labor market. And if that starts to break, things can get ugly. But the labor market looking very, very strong, very, very tight. At the moment, initial jobless claims this past week was actually better than expected, even if it was just slightly. And so when you look at this weekly chart in the S&P 500, it's very, very bullish. And really, if you're a technical chartist, right, you really only start to get worried when the S&P 500 gets below this 5,200 area, and ideally this like 5,000 area. Anything below here, that's where things get ugly. But, you know, there's a ton of support on the way down. And this looks like a very orderly sell-off in my personal opinion. But going to the daily chart, you can see this green candle right here. Now, yes, we did actually gap up. We never actually saw the close of yesterday, but we did see bears come in at the top here on Friday and sell us on the highs. So you can see here's the gap up, right? The gap up on Friday. Then we traded up. Then we traded down and closed right here at the 44.50 area. So we did gain 50 points overall, up 1.1% here on Friday, but still overall down for the week after this vicious gap down when we went into negative gamma. And this is essentially what the bulls need to do now. They need to provide follow through all the way up, either close above or sort of consolidate at this gamma flip zone. If they do that, that then opens up higher levels. But if bears make it all the way up here, it consolidates, and then we start having price discovery below the gamma flip. That probably opens up lower levels. 5,400 is an extremely key level. If the bears break 5,400, I think we can see 5,300 very, very quickly. I think if the bears break 5,400, we're going to see the put support move down to 5,300. It's currently at 5,400. So very interesting trade right now. The bulls have a lot of work ahead of them, but so do the bears. And I think if you're trying to make money in the S&P 500 right now, there's just a lot of indecision. It was very easy to make money here because the market just kept going up. Like right now this week, with this type of price action, with where the gamma flip is, the put support, the call resistance, the S&P 500 is looking like a mess. If you want to make money in the market this week, momentum is clearly in the Russell right now. This is where you want to be. This is where you want to make your money, in the Russell 2000. Let large caps do their thing. Let them correct. It's time to make money in small caps right now. I've been saying that for weeks and weeks and weeks, and we're finally at that stage right now. The IWM and Nasdaq are pretty much returned roughly the same amount this year. Let's actually have a look. Not quite. A little bit of outperformance here in the Nasdaq 100, but the place to make money right now is in small caps. So IWM, hold long. We're going to 240, and at the end of 2026, we're going into the 300 area. That is my prediction. In the S&P 500, I think if 5,400 breaks, we go to 5,300. If we're above 5,500, we're probably going to test the gamma flip. But I think this week, with all of the data we're having, I think the market is just going to wait for the data and then react. It's going to be very hard to trade the S&P 500. We know where the momentum is. It is in the IWM, and that's where we're going to make our money over the next couple of weeks. Now, this is the S&P 500 earnings scorecard. We're going to look at it again because there's been some significant changes. Just yesterday, reported earnings were at 11.6%. They're now sitting at 12.1%. We're sitting at a huge beat compared to what analysts were expecting at the start of earnings season. And revenue as well has actually moved up ever so slightly, right in line. We were actually missing on the revenue front just a couple of days ago. And this had to do with some of the better than expected earnings we actually got on Friday from 3M, as well as Bristol Myers Squibb, and some of the earnings reports earlier this week. So far, the fundamental side of the market is looking very, very good. Margins holding in there. So too is revenue. This is exactly what you want to see with stocks at or near all-time highs, especially in a bull market. You want to see companies meet their lofty earnings expectations. And growth expectations are officially near cycle highs. In fact, probably at cycle highs, excluding 2021. That's an outlier. Remove this situation and growth expectations are the highest they have ever been. This is S&P 500 implied 5-year free cash flow growth sitting just under 14%. That pretty much means 14% growth every single year for the next 5 years. To put that into perspective, guys, if you take $100 multiplied by 15%, at the end of 4.8 years, your money will essentially double. In other words, these expectations are telling us in the next 5 years, the S&P 500 is going to go up 100%. Seems very, very lofty. But at the end of the day, in bull markets, earnings typically grow a lot. And when we look at history's average EPS growth in bull markets, what we see is stagnation for the first year, and then we actually see earnings rip up in a very big way. This right here is this average bull market. This is what we're doing right now, and the S&P 500 currently is on a similar path trajectory to the historical average based on analyst estimates. In fact, we are underperforming it. And what we normally see is EPS growth run up in bull markets, and that is what the market is simply pricing in right now. But these lofty expectations will need to be met by more than just earnings. What we'll need is to convert those earnings into profitability, and that means margins need to increase. And right now, Goldman Sachs only forecast modest margin expansion in the S&P 500s, but margin expansion nonetheless. They see margins expanding to about the 11.8% range, which is good because at the end of the day, if earnings are going to grow, we also need margins to expand to provide those lofty free cash flow valuations. Otherwise, if we're not going to get the margin expansion along with the earnings, S&P 500 stocks right now are probably overvalued. And the S&P 500 have quite a number of tailwinds when it comes to expanding their margins. The first is simply rate cuts. The number of rate cuts this year is sitting at around 2. We're right now looking at a 25 basis point cut here in September and then another 25 in December, for 50 basis points worth of total cuts for the full year 2024. That is what the market is pricing in. It's kind of crazy that the market has continued to rally even when we were pricing in 4 cuts. This right here, the less rate cut expectations we get, just simply means the economy is doing a lot better than we thought. Also, capital expenditure from hyperscalers, Microsoft, Meta, Amazon, Oracle, Alphabet, and a couple of other companies continue to expand. They're seeing a jump from $133 billion in spend per year to 181 here in 2024. This number is expected to be 203 in 2025. So these big companies are pouring money into the market, and that's going to further support earnings growth as well as margin expansion in S&P 500 companies, and that in turn could further support the rally in the long term. Short term, yes, we do know what's happening in the market right now. Large caps coming under pressure. Longer term, this type of spend, rate cuts, could definitely materialize in higher earnings and margin expansion. It just depends how management teams effectively take this money and turn it into profits. And as July draws to a close, we cannot forget the fact that when we've had a positive year, particularly a positive quarter, in other words, May to July is positive, which it has been, up very close to 9% in 2024. We tend to see a negative August, down negative 0.57%, negative 0.65%. And when the May to July period is negative, August tends to be very positive. 20 up years, 8 down years, 0.9% return. In fact, when the trailing quarter is positive, we actually tend to see weakness here in August, September, and October. August and September tend to be negative on a median return basis, but then October flips to positive on a median basis, and then we actually see November and December extremely positive, both in average return as well as median return. So guys, this volatility we're going to see in the next month, or that we are seeing in the market, is just a reason to get bullish, because we normally do go higher. And as long as earnings expectations and the macro holds up as it currently is, stocks will go higher. Now, next week is another big week of earnings. In fact, this upcoming week is bigger than the week just passed. Now, on Monday, we have F5, McDonald's, onsemi, Philips. That's really it in terms of big names. Then Tuesday, it really gets going. SoFi, PayPal, Pfizer, BP, PG before the open. AMD, Microsoft, Starbucks after the open, as well as Pinterest, Arista Networks, First Solar, Caesars Entertainment, Lemonade. A huge day. Wednesday, just as big. Wingstop, Kraft Heinz, Altria, MasterCard, Meta, Arm, Qualcomm. After the close, Carvana, Lam Research, Western Digital, Riot, ACOM Software. A very, very big week here on Tuesday and Wednesday, especially for me. I own PayPal, I own Paycom. It's going to be a very, very big week. Then Thursday, probably the biggest market cap day overall. We have Apple, Amazon, Moderna, Coinbase, DraftKings, Roku. Huge day here on Thursday. And then on Friday, we have some of these like energy names: Exxon, Chevron, Frontier Communications. So a very big week of earnings, as well as a big week of data. The focus is going to be on the FOMC rates decision. Now, we are expecting a hold. You can see the consensus is 5.375. That's both as estimates. Previous was 5.375. So we're not expecting a hike or a cut, but we really have to pay attention, because pretty much after this July FOMC, the next one is September, and that's the month we're expecting a cut. We also have the employment report, NFP, non-farm payrolls. Both is expecting 225. The consensus is 175 non-farm jobs created. Private payrolls at 148. The unemployment rate to come in at 4.1%. Average hourly earnings 0.3. Average weekly hours 34.3. And then we have the usual stuff we do on an NFP week: ADP employment, mortgage applications, JOLTS, purchasing managers index. So a huge week of data with the FOMC and a big week of earnings. Now guys, I want to talk about yesterday's GDP. We finally got the data here from BOFA. This is the GDP summary table, and we all know the number growth came in at 2.8%, but the more important figure was actually domestic final sales came in at 2.7%. This is literally just private sector and government investment. This just flows on into the next quarter of GDP. Final sales came in at 2%. Very crazy figures when you look at it, well above the consensus expectation, which was just 1.9%. What we could actually see is that consumer spending very robust. It doesn't seem to me like the consumer's pulling back. We did see a drag here in structures, and then equipment goods was actually very, very strong, up 11.6. This was actually driven by durable goods as well as services. Non-durable goods were a drag, but compared to Q1, this is what let the Q1 GDP down. But we saw a rebound here, and we are expected to see a continued rebound in Q1 and Q2 2025. And we got a little bit of a note here from both. They say the economy remains on robust footing. The first print of second quarter GDP growth surprised to the upside at a robust 2.8%. This was even stronger than our above forecast of 2.3% and our final tracking estimate of 2.4%. The upside surprise on growth was supported by strong consumption growth of 2.3%. Overall, the economy continues to disprove skeptics. Growth has certainly cooled relative to last year, but it has done so at a gradual pace. The risk of a sharp slowdown is low in our view. Strong underlying momentum in the economy. Recall that Q1 headline growth was soft, but final sales, less trade and inventories were stronger, as trade and inventories were a drag in the first quarter. In the second quarter, inventories rebounded, adding 0.8 percentage points worth of growth, while net trade was a drag of 0.7 percentage points. Thus, final sales at 2.7% was about equal to the headline number at 2.8%. In other words, the headline print is a clean signal of where underlying momentum is in the economy. Again, we are cooling, but gradually. The Fed can afford to wait. Finally, to the extent of one GDP number affects our monetary policy outlook, employment and inflation matter more for obvious reasons. This report fits our view that the Fed can remain patient. We continue to expect the Fed to cut in December, though September has moved closer to baseline given recent economic data that points to cooling labor markets and a return to disinflation. And while the disinflationary trend is clearly intact, there are some risks we do need to be aware of. Unfavorable base effects will likely result in core PCE moving higher in the second half of 2024. You see this uptick right here. Even if we get 0.15, 0.2, 0.25, we should see an uptick in every single scenario towards the end of 2024 before coming down towards the start of 2025. The market will need to contend with that in the second half of 2024, but while base effects may lift the year-over-year rate, shorter-term measures should show strong disinflationary momentum. If we look at it in the year and now, we are in a clear disinflationary trend. And this is why the Fed actually want to cut rates, or part of the reason why they want to cut rates, simply because inflation is coming down. Interest rates are exactly where they were when inflation was 7-8% in the US. That means real Fed funds are extremely tight, sitting at 2.4% right now. That is the actual cost of debt. And for those of you that don't know, the Fed don't have an actual real Fed funds target, but it's pretty well known that they sort of want it at or below the zero line. Anything above here really eats into economic growth in the really long term. And that's why the Fed wants to cut. The economy's strong. Let's normalize policy. Let's uninvert the yield curve, and they do that by cutting rates. So we have to pay very close attention to what Jerome Powell says this week. And I think we're going to see something along the lines of Jerome Powell saying what he would normally say is we need greater confidence. He's now going to say something along the lines of we need somewhat greater confidence. When you hear that type of wording, you know cuts are coming in 2024, at least one cut, potentially two by the end of the year. So that's the type of wording we have to look out for. The Fed do want to cut rates. They do want to normalize policy. And the data they got this week gives them both the fuel to do so, but also the time to remain patient. The Fed's in a very good spot right now.